The Nifty holding above the 17,900 mark.
As we speak, we're down 70 points on the Nifty. The Nifty is now trading below that 17,800 mark.
You know, the market broke through the December 26th low, but briefly, 17,774 was that number. I think the low today has been made at about 17,761.
It's been a volatile trading session in trade today, but it seems that the weekly expiry came to the rescue of the bulls yet again.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading actions in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. Sensex and Nifty end with marginal losses despite a late pullback. Sensex slips below 60,000 while Nifty closes at 17,858. Broader markets underperform the benchmarks with IT stocks supporting the markets. NCLT Mumbai approves the merger of multiplex chain Inox and PVR. Sources say that a written order is likely in next 15-20 days. That's a CNBC-TV18 exclusive. Infosys beats estimates in the third quarter, revises the full-year revenue growth guidance upwards and maintains the outlook on margins. Revenue growth of over 2% is higher than TCS for the third straight quarter. Shares of Paytm's parent tumble in trade after 3% stake is sold in the open market. Sources say Alibaba's affiliate company Ant Financial is the likely seller of shares worth over 1,100 crore rupees. Crude oil prices remain on the boil, hitting one-week highs on the back of the China reopening and concerns about the supply of Russian oil. Top brokerages including Bank of America, Goldman Sachs, Morgan Stanley expect Brent prices to touch the $100 to $110 a barrel mark. All right, those are the top headlines that we are tracking for you. But as always, let's begin with the day's market action. Market ended the day lower, but it was sharply off intraday lows as well. Nifty and Sensex closed 0.25% in the red. The Nifty is now at 17,858. The broader markets underperformed the benchmarks. Prashant Nair is here with the details. Prashant.
Well, the market sold off quite aggressively, only to recover towards the end. We ended down about 30 points. It was volatile, not very wide in range. But it looked tricky at one point. That low that we've been talking about, the December swing low, that was broken briefly. We went below it by about 15 points or so, and then there was a sharp bounce back. I'll come to that in a bit. Banks, again, I mean, they were selling. Private bank index coming under a fair bit of selling pressure. Large caps which lost. Divi's Laboratories stood out. BPCL was under pressure. Reliance Industries, RIL, we pointed out yesterday as well. It's been weak for a while. And that is a problem because it's got about 11-12% weight on the index. Tata Motors was weak and there was Axis Bank which lost today. SBI Life, Ultratech and HCL Tech were some of the stocks which did well. Of course, earnings season is in full flow and some of these stocks will respond to earnings. Broader market breadth was 1:1, little bit in favor of declines, almost 1:1 then. So losses coming through in names like Paytm, where there were large block deals. Nykaa lost today. Divi's Laboratories, Gland, Granules, Stovecraft were some of the stocks which came under pressure. Gainers in the form of Navin Fluorine. Rate gain is up 20% this week, including today 6%. Cyient reported in the last hour. Stock was up 5%. BKG and a few others doing quite well. The market for now has held on to that 17,774 level, although with a bit of a brief break. So that still remains the level to watch on the downside. But I think what the decider is going to be the inflation numbers out of the US later tonight, which I think will set the course for risk assets when we come back tomorrow morning. Back to you.
All right, Prashant, thank you so much for that. Moving on to some market opinion now. Market experts tell CNBC-TV18 that equities is not the most preferred asset class today and valuations remain quite punchy relative to other markets. But all repose faith in the India growth story. Listen in.
In terms of the valuations, look, I mean, India is the most expensive market in the region, right? It's still trading at 22 times forward earnings, which is higher than the rest of the markets in Asia. India was trading at almost twice the valuations for the overall Asian region at almost 22 times. The region was at 11 times. So we had a premium of about 100%. That has come down to around 65%. The long-term average is around 30. So there is still some room for further contraction.
The reality is valuation upside is very, very theoretical because I think everything is costly. Everything is costly. So to put that into picture, I guess the largest sector financials is the one which is the consensus overweight. So we decided to hug with the consensus overweight there, and we have actually increased weights of financials. We also have a overweight of healthcare. which is a overbit which is continuing from last year. So last year it didn't do well for us, but then we think it's again a situation where things are bottoming out.
Over time, of course, private banks have shown the ability to increase market share relative to, let's say, public sector banks or NBFCs. But I think the key really in the longer run is to have a good liability and asset franchise together. And that's what's been supporting private banks. But all will exist because NBFCs have their own skill. And especially as you go down the population curve in income levels into tier 2, tier 3 and beyond, we call it India 2, India 3. The role of NBFCs is pretty important because they're able to reach out.
All right, that's some expert opinion coming in. Moving on to the second headline now, and it's a CNBC-TV18 exclusive. The merger of multiplex chains PVR and Inox has been approved by NCLT in Mumbai. Sources say that a written order is likely in the next 15 to 20 days. Both stocks closed with gains of 3% each. Nimesh Shah is here with the exclusive details. Nimesh, what are you picking up?
In a CNBC-TV18 exclusive, what we understand from sources that the Mumbai NCLT has today finally approved the merger between Inox and PVR. In an oral order, the judge has pronounced the merger. Now, the written order is expected in the next 15 to 20 days. Now, we all know the merger ratio. It's basically 3 shares of PVR for 10 shares of Inox. After the written order is through, over the next couple of months, the merged entity will emerge. Now, what will the merged entity look like? The merged entity will have a network of more than 1,600 screens pan-India, and the merged entity is aiming to add at least 200 screens every year. Now, both the promoters will have 2 board seats in the merged entity. The Inox promoter will have a slightly higher stake of 16.67% in the merged entity, whereas the PVR promoters will own close to 10.6% stake in the merged entity. Now, the merged entity will have a market share of 40% across the 7 big cities. So that's the big conglomerate which will emerge after the merger. But in the news, today the Mumbai NCLT has approved the final merger between Inox and PVR.
Nimesh, thank you so much for joining us with all those details. Now to the third headline of the day. Infosys reported a beat on its top line in the third quarter. Margins were a slight miss. However, the biggest takeaway is that the company has revised its FY23 revenue growth guidance higher from 15 to 16% to 16 and a 16.5% mark. Reema Tendulkar is here with the details. Reema, take us through the key highlights from the IT majors third quarter.
Thanks so much for that. It's a very strong showing from Infosys this time. A revenue beat, a guidance upgrade, very strong deal wins. But there is a bit of a margin miss. But on the whole, it's a good quarter. So let's tell you about the numbers. Revenue growth has come in ahead of expectations, 2.2% in dollar terms. Constant currency revenue growth has come in at 2.4%. EBIT margins are flat at 21.5%, and this is despite 40 basis points benefit due to the rupee depreciation. In fact, both Infy and TCS have reported a revenue beat and a margin miss. But if I compare the revenue performance, Infosys growth rates are stronger than that of TCS. The big positive was the fact that revenue guidance was revised higher. It now stands at 16 to 16.5% constant currency revenue growth for this year, which compares with the 15 to 16% revenue growth that they'd earlier guided for. In fact, every single quarter of this year, Infosys has gone ahead and upped the guidance. The deal wins are also very strong. Deal wins, the highest in the last 8 quarters, have come in at $3.3 billion.
But Reema, that's not it. Even HCL Tech reported its earnings for the third quarter. How were they? Tell us the analysis.
HCL Tech has reported a revenue and a margin beat. Now, this is the third consecutive IT company which has reported a revenue beat this time. Both Infy and TCS had reported a strong top line, and now it's HCL Tech. HCL Tech's dollar revenue growth has come in at 5.3%, much ahead of expectations of 3.5%. Constant currency revenue growth of 5% is also looking solid, 13.1% on a year-on-year basis. Margins is where HCL Tech has beaten its peers in terms of a surprise. Now remember, both Infy and TCS margins missed the mark. But for HCL Tech, margins have expanded by 165 basis points to come in at 19.6%, and this is much ahead of consensus expectations. A quick word on the full year guidance. FY23 revenue guidance is now seen between 13.5% to 14%. The earlier guidance was 13.5% to 14.5%. But in December, the company said that growth rates will be at the lower end of their guided band. So that's what they've done. They've tweaked the guidance and they've said that it'll be 13.5% to 14%. Services Infosys revenue growth between 16 to 16.5%, and EBIT margin guidance band too has been narrowed towards the lower end of the earlier band, and now it stands at 18 to 18.5%. The deal wins are steady on a quarter-on-quarter basis, coming in at $2.35 billion. It's up 10% year-on-year. So it's a strong showing from HCL Tech, a beat in revenues and margins. FY23 guidance has been tweaked, but that's in line with market expectations and the company's own updated performance in December.
All right, Reema, thank you so much for all that analysis, but it's time for a break now. Stay tuned. We'll be back in a bit with the other headlines.